Why should I set money aside for investments? It's a question I hear a lot from people, especially younger age. Why should I set money aside? I got all this time before, I'm gonna retire. Why should I invest? I just wanted to start off by saying that this is not financial advice, it's educational. So I want to help you by educating. Now, I want you to use this education to take action by seeking out the financial advice because really I don't understand your situation, but what I do is experience that I've heard from a lot of people. And I wanted to share that. Well, why should I set investments aside? And it's such a big question. There's so many answers. If there was one perfect investment, everybody would be leaping on it and milking it for every dollar. But the thing is that investments depend on the person entirely, especially tax efficiency. Not as tax efficient, more liquidity. But the real point is, why the hell should I set money aside? I wanted to enjoy stuff, but really the point of setting money aside is so that you don't have to worry about money later. Especially having the foresight to understand that not only is the cost of living going to increase, but there's going to be more variability and different things going on in life. If you want to be able to cover those, making investments is the way to go. I mean, it's crazy how many people don't have investments, and especially from a lot of people who've had investments, they always say, I wish I started sooner. I wish I started sooner. And really, as early as you can, even. I mean, there are a lot of financial advisors and people who, say aim for 15 to 20% of your income to save. That's good. But, a lot of people have different financial situations. So, those are the golden numbers you want to strive. But the main point is just to set something aside for those investments. And even if it's a couple $100 at the start, I mean, you hold that on for years and years, it's gonna be worth more, like a couple thousand, which you may think, how the hell is that possible? But it's really compound interest. It's that the amount multiplies by the market appreciating over time. And it appreciates past inflation and makes you actually a good deal of money. Now, yeah, you are going to pay taxes on it unless you use tax advantage accounts. But just setting that money aside and saving that money will save you a lot later by really giving you such a high wiggle room for so many different expenses and different things that, like, that's the whole reason of retirement is that you want to save enough money that you don't have to work anymore. But why not start making those investments sooner so that your basically net worth is worth a lot more, and most of it grows through time. And that's why investments are so important, is because they mostly depend on time in the market. Like, Warren Buffett says too, it's the time in the market. Yeah, timing could make you in the short term, but that's not as an investment as it is into speculation. But really gotta start investing. I mean, I started as a kid with the Fidelity Youth account. It's crazy. Just put a couple hundred in, then it grew to a couple thousand, and it's still growing. And I did the calculation. If I just held on to it for a long, long time, plus put in money that I'm making from job, extra stuff. I'm teaching myself trading, but that's a whole different thing of speculating. Um, I don't recommend it because it it's risky from a mathematical perspective. Think about it as a standard deviation chart. Standard deviation for trading is way down there. It keeps going. What the upside is so high, but the amount of space in between that you could lose is why it's such a that's why it's speculative, because there's just so many standard deviations in between you and the prize money. And that's why you want to make investments. Yeah, you gotta have some money to speculate, but I'm really doing it like this. I have 90% in long term investments. Long term. Now I'm 19, so I had the foresight to, actually get this stuff off the ground. But, you know, the way that I'm doing it from personal experience is that I have 90% long term investments, 10% speculation. That 10%, I'm willing to lose everything of that 10% as long as I learn something. And I'm learning that, with trading, it's so much speculation, but it's almost an entire emotional roller coaster. And if you can get rid of those emotions, it makes you some money. Now, to be good at trading, you gotta be good at math and really mental math, like visualizing and thinking about your implied volatility, all of these different. There's all these Greek symbols to determine probability and uh if it's worth it and how much the value decays or appreciates. But what is the most important thing that I think is to have the investments just set up like, why should I invest? Well, because I'm gonna have such a higher return in the future because I had the foresight to realize that I'm not gonna know what's gonna happen in the future. But if I'm gonna have money that has been growing up to that future point, whether it's unknown or not, that you have all that money, I mean, even like just for me, if I just let those investments growing and eventually I could use it to start a business or something where now I have room to speculate because I had the foresight to make those investments. Like me, I was thinking of once I had more money, as long as alongside me aspiring to be a financial advisor and also get there. I'm not currently one, so I'm telling you from experience what kind of goes down. And yeah, I mean, when it's young, it's good to speculate, but not to where you lose everything like crazy. It's to learn because you know I learned about all this risk management stuff before somebody who's in their 30s. Well, that sets me so much apart, and I kind of want to make videos going into trading, but I don't want to get your hopes up that you're gonna get rich. Now, you can, but how many standard deviations away are you? You're a crazy amount away. And that is why investments are so important. There's the standard deviation curve for investments. Like you got bonds at the bottom, and then you work your way up, and then it curves. And then the top is like venture capital, like your standard deviation. And it's this far, but the upside is way high. But the risk in between that is almost unbearable unless you're willing to risk all that money. And then it goes down. You got private equity, then you got stocks. You got more risky stocks. Then you keep going into not as risky stocks, but you go into ETFs. So they're lower standard deviation compared to equities, but it's slightly less return, but it curves. And then at the bottom, you got like savings accounts, and it's more of like cash equivalents. And then you got like, because you're gonna be holding on to that money, you're not getting that much of a return, but you have to realize that inflation also counts in that risk. Inflation varies a lot, but if you're just sitting there, you have a low return, but you're losing money to inflation, that you're still risking that money and not getting it. And then you go to bonds, so they return more than inflation. Then that curve of standard deviation, all that risk, less risk, a little bit more risk because you're just holding out the money. It's not really getting you anywhere. And that is why investments are important. And you want to be in this area. So, that curve, and then you got bonds, ETFs, equities. And then there's a variance of equities of, how risky the stock is, and then private equity, and then venture capital. But really, the best investment is somewhere along that curve where your risk is much less compared to your reward, and that that's where you want those long-term investments. Like I started with just Vanguard S&P 500, SPY, the SPDR, S&P 500 ETF. Like just start with those, and then over time you start building money into different things to lower your correlation. Because another thing that many people don't tell you about investments is correlation, and the correlation between multiple investments. Like, for example, they're all correlated to the stock market. When it crashes, all your stuff crashes. But if something is not correlated to the stock market and is still appreciating, regardless of a market downturn, that lowers your risk significantly. Like one of the biggest ones and benchmarks for hedge funds, funny enough, is the 60-40 rule. So 60% in stocks and equities, and then 40% in bonds. And bonds, they slowly appreciate. They vary by, treasury yield could influence certain bonds, but if you're in corporate bonds, they're really stable. Unless it was like 2005 or something and they were selling you crappy mortgage backed securities. You know what happened a couple of years later, but that's a whole nother issue. But really, the point is that you have 40% that's low risk, and you have 60% that you're willing to take risk on, but the upside is way more. So when you combine the 60-40, you get the equilibrium of risk where you're going to make money. It's just a matter of risk tolerance, and really you want to take more risk to be able to secure that. And I think the return was around same thing as the market, but a little bit less. So it was around 8 to 9%, which is good, especially for the stability. And that's the kind of benchmark you want to beat, because it's much lower risk, but also has a good upside from the equities, and then you got bonds. That's when you want to strive for a perfect retirement, because you want to draw from the bonds in the market downturn, because they're not correlated, and so they're much less standard deviations away, making it much less risky. And because there's not a correlation, your forgot the Greek symbol. I think it was your omega, so your risk to reward ratio. And really that's what you want, because if market crashes but you still have bonds that are actually appreciating because people are buying it, and the market crash and also pay you those distributions, like you're looking at the market fall, but your withdrawal rate stays the same. You're just withdrawing from the bonds instead, and then when you wait for the equities to go back up and over break even, then you start withdrawing from your equities, using some of that excess to put maybe in more bonds. But the bonds, they pay distributions that allow the dividends to be reinvested. So the stock market constantly fluctuates, but you want your withdrawal rate to be at a straight line. Straight line. And to get there, it's by managing your risk. So that's the bonds, right? And to keep that straight line of your withdrawal rate without influencing the value of your thing too much, because you're pulling from the bonds when you're not pulling from equities. And that's why you should invest. It's to make more money in the future by expecting a return, and really long term, but also because you want to prepare for the future and for the unknown, and to have money later that you could just enjoy. Yeah, like I've heard some crazy things about people are spending the money now because they never know what's gonna happen. But well, yeah, you might be right in some sense, but if you were willing to have that discipline and instead save that money, and instead of splurging and spending on whatever, having it later, you'll be able to have like double or triple the amount of fun. You just have to wait a while. You know, that's that's really where the discipline comes in for investing. But there are people who have the fiduciary responsibility to get it right, and you want those. Or you could do it yourself and take on the educational risk and paying the price for that learning curve. Which I did at the beginning when I was younger, and now I'm starting to transition into a professional career in that. Maybe I'll be a trader in the future, but helping people with money is what I want to do. And I mean, I've heard all this stuff about wealth inequality and all that stuff. I think it's inequality of knowledge. People that deserve that knowledge, and that is one reason why. And it's not really. I mean, yeah, it in some sense it depends, like how much money you have when you're born, and you can't choose that stuff. But what you can choose is the knowledge and the discipline. And there are people that are out there that help you. Like, you can also reach out to me on my social media, and if you need help with that kind of stuff. I mean, I have the opportunity to work with experienced advisors while also learning from my past experiences and investments, and learning by actually doing it, and help people in the present have someone with the fiduciary responsibility alongside me to help make those good decisions for you. And I get to make some money. You make even more than me in value creation. That's why the financial advisor and financial planner jobs are so important, is because they have such a high value creation relative to what they do. And that's why it's just so important. It's kind of up to marketing, marketing why you should have investments. Like, show people that, through explanation. I'm willing to make these videos and take the time to, explain why investments, but there are people that are out there to help you. There's a lot of scammers out there, so be aware of that. But, you know, just do those investments and make those investments too, not just, like go out and want somebody to help do them, but, actually make the contribution. Your future self will thank you like no tomorrow. I'm telling you, everybody who's older say they wish they started sooner. Everyone. I don't. Uh, it's easier to say all the people that wish that. It's hard to find somebody that didn't wish they should have invested earlier. I mean, that's crazy. It really is. And you know, it's those crazy things that not everybody knows, and why you should invest, because for your future. That's to break it down. And also not just that, but you know you don't know what the hell's gonna happen in the future. And if you have a ton of money in the future because you made those investments, well, good for you. And that's why it's so important, because of those reasons. It's such a good thing to do.